welcome to our next episode for ECK, Public Voices. And today we have someone who is a hardcore Liverpool fan, but he's nowhere mediocre in his work as Liverpool is when they're performing on field. Okay. So Brad is a former head of Asset Allocation with Mason Stevens, on his way in establishing his own outsourced CRO solution, and previously has done a lot of work with AMP on their asset allocation side as well. So someone who is very well versed in looking at how portfolios should be constructed on an asset allocation basis. In the world that we live in today, there's no better person to speak about how we should be viewing the events unfolding. Definitely much better than relying on Liverpool. So welcome, Brad.
Thank you, Karam.
Do you want to share with our viewers a bit about yourself, your background, your journey so far?
Hi everyone, my name is Brad Creighton. I'm an aspiring CIO in the process of setting up my own OCIO business. First and foremost, proud dad, frustrated sportsman.
Liverpool
fan, big Liverpool fan. Liverpool are not that bad. There's a metaphor in there for active management. Last year, they had a very positive excess return. They were expected to come in third or fourth and they won the league.
Oh.
And so this year,
there you go.
They're expected to win convincingly, and fifth or sixth might be a good outcome. But over time, under a good manager, Jurgen Klopp, we had, and now Arne Slot, not quite as good, but the journey has been a positive one. So,
there you
good
go.
Result for Liverpool and a metaphor for active management.
There you go. We have worked together in the past year through your time at Mason Stevens and also personally as we restructure a lot of your personal holdings. I wanted to explore a bit more on the piece of conversation around portfolio asset allocation. Do you mind sharing a bit about your background and your expertise in this field with our viewers?
In asset allocation, yeah. So when I started my career, my dad was always very passionate about investing and spoke about his super. To get towards a level of expertise in my career, I felt I had to take a road slightly less travelled. I didn't go to a super fund. I went into a hedge fund unit within the Commonwealth Bank of Australia, and I started there on the trading floor. I had some roles in market risk as regulation clamped down on risk taking. I went to London and I had a few contract roles at Credit Suisse and Aviva, so I'm starting to get into the buy side. And then I got a job, probably the most formative one, at Millennium Capital Partners. Big hedge fund, always at the top of the tables performance-wise, and ran a discretionary global macro mandate with a very senior experienced trader, and I just learnt so much. Being on Bloomberg Terminal 20 hours a day is a really powerful, true learning experience. And I came back and was able to apply that at AMP to super funds and active strategies. And I got a tremendous amount out of that. I worked with some great people, Diana Messina and Shane Oliver, if I'm allowed to drop some names, as well as other great PMs. And now I'm realising through talking to advisors in that network that some of their needs still cannot be met by the traditional ecosystem. And I have an open mind and a skill set that enables me to lean into some of those problems.
Shane Oliver is one of my favorite economists in this country. I do follow his articles quite religiously. Speaking of that, now, the environment that we are living in, constantly on a daily basis, you jump onto LinkedIn or through the media, there's always the debate about passive versus active. How do you view that? How are you positioning portfolios? What are the trigger points or cues that you look for when you restructure an asset allocation shift?
Yep. And stepping back, before you even get there, I don't preach either passive or active to any one person because it's an individual thing. First and foremost, I advocate for investing. Try to invest from as early age as you can, which sounds really obvious, but build the habit. First and foremost, that's essential to wealth creation. And then secondly, we want to avoid behavioural risks along the way. If passive is suited to you or your clients and you don't want to deal with noise to do with active management and tilts and all that, and you just want to get them in play, passive is right for you. And I find that passive aligned clients go to passive aligned advisors, and those advisors focus on efficiencies and other estate planning and whatever, and that's a happy marriage. And then there's a lot of people with also an open mind and realising that perhaps we're shifting into a new regime and that fundamentally there are a much bigger opportunity set as well as the world changing, and maybe there's a way to harness that opportunistically in portfolios. Okay, so it's a broad church. And my job, as I see it, is to understand how they see the world and what their philosophy is and where their comfort is, not to impose my views or a house view. I've got to get to where they are and then help them navigate it better. Or as best we can. Now, as a real quick situation, I do have a client who's quite active and decisive and moves in large size and has achieved great results for their clients by doing so. And we come into a situation like Iran, and I can fall back to millennium expertise at trading these events. It doesn't mean it's easy. You can, at the onset, say the US and Israel have an overwhelming military advantage. This will end quickly. But you don't know. And then fast forward a week later and Iran is proving very, very defiant. You can go into the world is not as reliant on oil as it was in the 70s and during the Kuwait instance. And you can do all this modelling, but it comes down to there's some human actors and what Trump says might not be what Netanyahu does. It's a very fluid situation. From a practitioner point of view, you then have to weigh what's the asymmetry in market, because you can have a worldview, but is there any value in pursuing it, or are you going to get churned? Where we stand today, and we took some action to de-risk portfolios during the week in this particular client, was what I can say for sure is, not for sure, but with high confidence, is that it is a short-term stagflationary impulse. Okay, oil goes up and that hurts duration assets and bonds, and the yields hadn't really moved that much to reflect that. They were noisy, but there were chances to get set. And equally, the macro picture is a bit more vulnerable than it has been. There's private credit concerns. Non-farm payrolls was very weak last week, so that narrative's deteriorating, and there's higher interest rates weighs on the ability of private asset firms to fund the next investment, and it discounts assets. And long story short, a few days ago the S&P was only down 2% from its February highs, and we've got a major potential tail event taking shape. If you can act quickly and decisive enough, I felt like there was an asymmetry there where bonds and equities were both in jeopardy. And so it made sense for us to de-risk the portfolios in that way and look to recycle into assets that we like when the opportunity arises. And now here we are today. We know that Trump has said that we're very nearly done pretty much.
Voice over.
That's what he said. And you can actually go, okay, it's been a week, maybe a week hence, he is nearly done. He's starting to look like his confidence is waning. And there might be a few more instances of missiles and whatever over the weekend, and then he withdraws. Okay, you can make that argument. You can say that they've got 400 million barrels coming out of the IEA. That's 20 to 30 days of lost production through the Strait of Hormuz, and then countries have 90 days in reserves. Not all countries. Japan has 200, Australia has 30.
36, I think.
Europe has a bit more. It's kind of inverse. The more reliant they are on imports, the higher their reserves generally are. So you've got a few months leeway there. But if you want to just not get bogged down and fall back to macro picture fundamentally at the margins is a bit weaker, add in a tail risk, and there's valuation, and I'm not selling when the market's down 10%, and that client is happy to do that, then I can implement that, and that's where we're at.
I like how there's a lot of behavioral economics that links back to all of these theories and theses and market cycles. Just a slight segue from it. TECO. Will Trump still follow through that TECO strategy, really, in this situation with Iran? Do you think that would be the place that he's looking at, given the backdrop of the American economy and the popularity of his administration within the States as well, and going into a separate country and doing things that he didn't promise to in the last election cycle? And how much of that will impact the behavioral economics of investors at the end of the day?
It's been a good cue up until now that Taco, the Trump always chickens out. We discovered that probably May last year when he started walking back on the timeline for tariffs and the scope of the tariffs. So markets can shake him out of a plan. And equally oil, which raced from the 60s into the 120s, and shortly after he's come out and said we're pretty much done. That's Taco. But he's not the only actor. And you've got Netanyahu, who's likely initiated this conflict, and the US has followed them in. I don't know, but that's one possibility. Is he going to fall in line because the US wants to end it and Trump wants to end it? So I don't know. And the new Ayatollah in Iran, who knows anything about that individual, really? I mean, there are some
not much known.
experts that know, but all I can discern is that he's much like his father in policy and ideology.
That's right.
And they killed his father. So he's got a natural vengeful motivation, but without trying to be an expert on something that I had to think about 5 minutes ago, there's a lot of actors with different incentives in there, and it almost doesn't matter what Trump wants to do in a sense. Because things can still carry on. And there's a strong incentive for Iran, you could say, to deter future aggression in the region. They can't go toe-to-toe with the US and Israel, but they can teach the world and all the neighbours a lesson that if you do this to us, then our recourse is to disrupt your trade and your economy.
Yeah.
That's all we can do.
Yeah.
So all of that's in flux. And like I said, it just comes back to when I look at markets and value and knowing from other analogues what can happen, is it worth positioning in A or B? And what does the client want?
Yep.
There's other clients where they don't want to play in this space, and we can go, great, let's look at this from an accumulator point of view.
Yes.
If we get the correction, where are we going first?
Yep.
And we can map that conversation out in the same way that you just mapped out for me how I manage my financial future.
Yep.
Let's map it out.
Yep.
And as long
Correct.
as we're hitting their objectives and creating their philosophy, bringing that to life,
Yep.
we address some of the behavioural issues and we get better outcomes.
Having managed a couple of $1 billion in your career, and from the time of GFC to where we are today, if you have to segregate, say, between retail, ultra high net worth, and a family office type client, what are the key themes that you see that has changed, or a prominent theme in these three separate categories from when you started your career, assuming around about GFC timings till we are today, which is possibly looking at another crisis that we are facing?
Yeah, full disclosure, because I wasn't interacting with the retail and the advice clientele for that whole time. It was from 2017 onwards.
Okay. Yep.
What I see though, and around 2018, there was the Royal Commission, but there was also the SMA,
Yes.
kind of the creation
Yep.
and that
Yep, the
inflection
popularity,
point, rapid growth, and it's still going on. And then you had the democratization, I really don't like that word, but the opening up of access to enhanced analytics, but also different asset classes.
Yeah.
And that raises some questions, and some people are against the complexity, and active management hasn't had a good track, and so they will avoid it, and that's your passive cohort and sympathisers. But equally and increasingly, it's raising questions, and I see more and more people being open to exploring different exposures.
Yep.
It oversimplifies the picture when you're talking about family offices and high net worth and ultra high net worth, just to talk about listed and unlisted, what your house model would be, how you would invest with a blank sheet of paper is essentially what that's saying. You've got to pick up on where they're at, what they hold. Do they hold agricultural assets or commercial property? What are their exposures, which they can't liquidate and they won't liquidate because it's part of their trust, their estate.
That's right.
It's part of their philosophy, but their advisor in their best interest is saying you've got some gaps.
Yeah.
And then how do we solve for the gaps and optimize for some income objective or some liquidity or some timing? That's a different problem set as well. Having knowledge of the macro, but then also the roles of all the different fund managers and the products, and that's where I'm passionate and lean into.
Yeah.
It's solving for a problem.
Got it.
And all of that other stuff is factored into the decision, but it's more than just macro.
Yeah. Speaking of that particular topic around it, how do you see, or how would you encourage advisors in working with asset allocators in determining the right outcome for the client? So what would be the key message that you would send to advisors out there who are probably sitting on the fence about it, thinking about it? How can we improve efficiency in our firm? How do we pick an asset allocator, essentially?
In the same way when I would interrogate, or a manager research expert would interrogate private credit, private debt, have they been through a work through? So how seasoned are they in the discipline of selecting private credit? Loans. How seasoned is your asset allocator in managing risk? Because there's a lot of financial professionals and there's a lot of access to financial tools. And I often use a sporting analogy. You use Liverpool. I play football, but I can't play in the Premier League. Okay, just because it's there doesn't mean you're good at it.
Yeah.
And just because...
That's a great analogy. I'm going to use that.
And just because you're in finance doesn't mean you can manage money in a way that consistently serves the client.
So you're telling me I shouldn't be listening to all these influencers on TikTok?
No, you just need to interrogate them for their actual track
Fair.
and the experience working on the problem set that they have, because peddling a house view is no longer acceptable or sufficient. And I think that's what the advisors are waking up to and why they're reaching out to begin with. So they need to filter for the right type of person, and in many cases it won't be me. They will need something else, and that's just the truthfulness of it. Who do they have the rapport with and the trust and the confidence in, given their problem set?
Yeah, absolutely. Private markets. So there's different layers of private markets, but there's a growing trend, growing popularity, not just among advisors, but I'm starting to see that a lot, on the likes of TikTok, Instagram, and there's a lot of talk about it. Where do you stand in terms of private market allocation today?
Private markets are just a very fertile hunting ground for investors. And part of the private sphere is deregulation or regulation, I should say, in response to the GFC. Higher risk-weighted asset charges at banks forces a lot of those very high caliber bankers, and I know some of them, to set up their own shop and opine on small to medium enterprises. And some of them go into the venture space, and these assets have enormous potential. So when you talk about private, what asset are you talking about and who's managing the asset? But at a high level, right now today, some of these less liquid structures and private credit can pay 7 to 12%, and it's not without risk, and private credit's under the spotlight for that.
Yeah.
But going back through time and trying to build wealth, if someone says to me, I can give you 10% year-over-year returns without the vol and the noise of listed assets, you would take that every day. It should be a meaningful part of your portfolio.
Yeah.
Because the S&P 500, for example, has grown at a roughly 10% annualized rate. The earnings growth has somewhere around that, but you wear a lot of volatility and behavioural risk. When you're navigating that, you could just buy and hold and avoid the behavioural risk, which is what the passive advocates will say, which is fine and slightly naive because people do have to make decisions at times. But you can partner that with something that offers the same return with an accrual style revenue, which is very complementary in a portfolio.
Yeah.
And so when you look at true diversification, it's royalties to mining rights in America and different countries, and land rights. There are managers that can access all of these things. As global supply chains recalibrate, trade finance is also something that yields 8 to 12 at the moment to meet short-term cash flow needs.
Yep.
And it's not all disruption. There are intra-regional opportunities in Asia's doing a lot more trade. It's solidifying trade routes, and they still need trade finance. And if I can get a nice yield and a nice risk-adjusted return over there, providing that's what the end client is comfortable taking in terms of liquidity risk,
Yep.
you have to introduce those things. And the last point is the digital ecosystem. I'm talking about
Yes.
blockchains and the guardrails that are building there. You have to get off zero in terms of zero allocation to that, and then your comfort determines where you go. Is there a future where Circle and other names replace or eat into the market share of Visa and PayPal and others? Because you can disintermediate. I can transact with you. I can share real world assets with you, wallet to wallet, with less friction and fee scraping from the majors, instantaneous. Once that gets rigorous enough, it makes so much sense that that would be part of our life.
Yeah.
So even if you don't think it goes that way, I question how can you have no exposure to something that could be fundamentally disrupting the incumbents?
True.
So I want to be there,
Yeah.
and it's worth exploring.
Absolutely. I think I fully agree on that, because I'm starting to see, or at least what I think is, there's a localized approach in where economic regions are being created now. There's a lot more corporations in a localized region. So I'm originally from Southeast Asia. And what we are seeing is there's a lot more cooperation between the ASEAN nations moving forward, because there's too many disruptions outside our region.
Yeah.
So we're starting to go, what can we do together even stronger? And that will just create a whole new ecosystem in all these different localized regions. I'm also an aviation geek, so I was looking at all these aircraft movements and airlines and what their plans are in the short, medium, long term. There's a lot more focus on localized expansion plans. And I think the whole disruption now that we're seeing in Doha and Dubai is a perfect example.
Yeah.
What is driving are airlines that are more regional. So the likes of Cathay, Singapore, Scoot, where their services is not entirely based on global routes.
That's right.
And I think that's where it's important to look at it from that lens, even on the asset allocation portfolio-wise as well.
It's a great point. And on the Middle East, everyone's looking at the geopolitical risk at the moment and focusing on oil again and kind of old fossil fuel economies. It's one of the cheapest producers of renewable energy in the world, which is why the digital ecosystem is setting up camp there to get cheap and constant energy.
Interesting. Yes.
So from that angle, I want to invest in the Middle East, in the new economy.
Yeah.
And in Asia, I know the trade's been disrupted, but the economies of scale today and the capital formation there is fundamentally different to if it happened 30 years ago.
Totally. Yeah. Yeah.
So all of that is often overlooked, and you really just need to do your due diligence or have someone that can do it, establish your desire to go after the things outside the passive index.
Correct. So if I was to come up to you today and say I've got $20 million, what would you do?
A lot of the things I've just mentioned. So $20 million, I would have a meaningful allocation into venture capital towards digital assets and payment systems. And that's not crypto crypto. I'm not buying crypto, although I do have a small allocation. But the economics of this digital ecosystem are far beyond crypto speculation.
Yeah.
It is the medium of exchange and verification between you and I, but the wallet providers have their own economics, and the infrastructure providers, and then obviously data centers, but it's run fairly well so far.
Yep.
And then I'm looking around for royalties tied to gold and energy in the private asset sphere. I think that's really attractive. There's a few list options there. Unlisted things, because I'm only just into my 40s. I've got to work till I'm 67, you just told me. And so I've got time. And so I'm happy to bear the liquidity risk and roll things 5 and 7 years at a time. And there are stronger opportunities there because naturally there are less eyes and less expertise and more inefficiency in these spaces. And that's why where active management has a role. You get the subject matter experts to identify those opportunities, and there are going to be more of them there than there is in the NASDAQ, where Claude can tell you everything you need to know, and there's an army of 100,000 analysts looking at NVIDIA every day anyway.
Yeah, true. We need to have another conversation all about AI in itself. The scale of disruption, I think a lot of people have not comprehended, and there's still a lot more coming through yet in this process. And it'll be interesting to sit down and have this conversation in the next 12 months in a completely different environment because of the level of disruption AI is going to bring about in the next 12 months. I also saw the whole piece about space data centers in the AFRO, one of the other major newspapers. That's something I'll be interested to have a chat and explore as well.
Yeah, I'm a complete tourist, but I've looked into it briefly. It makes a lot of sense if you put the solar panels and the power generators in space. Sure, except for the fact that there's a lot of particles in space and radiation that will destroy the solar panels. And so from what I can gather, it requires a lot of thinking and investment on the shielding of the solar panels to make that capital investment not decay through damage over time. It's and there's a lot more work I have to do on it. But they're looking into these things, and I'll continue to monitor them closely because that's interesting and it could be very lucrative. A much cheaper way, once you can solve for those problems, to generate power.
Yeah, absolutely. Well, that was a very insightful conversation. Thank you. And I think what I'm really hearing is we live in such a volatile world right now, and things are changing so quickly, constantly. It is important that we, whether you're an advisor, investor, asset allocator, you just have to really understand what your risk preference is and look at the broader piece around what are the trends emerging, what are the trends over the next 12 months, what is being in focus today, what has changed, and then adjust your allocation piece based on it.
Yep, I agree, Karam, for your time. And it's always client first. Where are they at and what can we do to enhance their investment journey?
Absolutely. All right. Thank you.